Welcome to Factful Finance. Today we're diving into a question that's on the minds of so many. Why do the rich stay rich during massive market crashes, like the recent $4 trillion dip in the stock market? And, more importantly, how can you stay financially strong too? You've probably seen headlines flashing about a $4 trillion market wipeout. The S&P 500 dropped more than 8% in a matter of weeks. Tech stocks like Tesla lost billions in one day, and investors everywhere were scrambling. But here's the kicker: the rich didn't panic. In fact, many of them kept growing their wealth. What's their secret? Let's start by understanding the financial environment during a market crash. When the market plummets, most people react by selling off assets, fearing the worst. But the wealthiest individuals and savvy investors don't fall into this trap. Instead, they see opportunities. Why? Because they understand that the market operates in cycles, ups, downs, booms, and busts. For them, it's less about the daily fluctuations and more about positioning themselves for long-term growth. Now, let's break down exactly how the rich protect their wealth during times of economic uncertainty, and how you can use the same strategies. 1. Diversification, the ultimate hedge. The first thing the wealthy do differently is they don't put all their eggs in one basket. Take a look at their portfolios. They're spread across a variety of assets: stocks, bonds, real estate, private equity, and even alternative investments like art and commodities. This diversification allows them to weather downturns in one sector while their other investments hold steady or even thrive. For example, during the 2008 financial crisis, many high-net-worth individuals were insulated from huge losses because their portfolios were balanced across different asset classes. Instead of panicking during a market dip, they simply rebalanced their portfolios to ensure they were in line with their long-term goals. 2. Access to capital, the power to buy low. Another advantage the rich have is access to capital. When a market crash happens, they often have the cash reserves to buy assets at a discount. Stocks are on sale, and they're ready to pounce. Whether it's real estate or high-quality stocks, they see the dip as a buying opportunity. You may not have billions to invest, but you can still take the same approach by focusing on long-term, quality investments when they're undervalued. Let's take the example of Amelia. During the 2020 market crash, while many were holding on to cash out of fear, Amelia, a savvy investor, saw the value in blue-chip stocks that had dropped in price. She bought shares in companies like Apple and Microsoft when they were down, and over the next year, her portfolio was up by over 25%. 3. Emphasis on income-producing assets. A crucial difference between the rich and the rest of us is the way they think about income. Instead of relying solely on the appreciation of assets, the wealthy focus on investments that provide a steady income stream, like dividend-paying stocks, rental properties, or private businesses. These assets generate cash flow regardless of market volatility, which keeps their wealth growing even during downturns. Henry, for instance, invests in rental properties. When the market took a hit, he wasn't concerned because the rent payments kept coming in. It's this consistent income stream that shields him from the volatility of the stock market. So even if the market value of his properties drops, his rental income is a stabilizing force. 4. Tax strategies, deferring and minimizing. Let's talk taxes. The rich use tax strategies that most people don't even know about. For example, by holding assets in tax-deferred accounts like IRAs or 401ks, they're able to delay taxes until they sell. Additionally, they often use tax-efficient investments to reduce their annual tax burden. Noah, a tax expert, explained that the wealthiest individuals use techniques like tax loss harvesting, where they sell losing investments to offset gains and reduce their tax liability. This tactic isn't just about saving money, it's about ensuring more of your wealth stays working for you in the market. 5. Long-term focus. They don't get distracted. The rich are known for their patience. They don't sell their investments at the first sign of a downturn. Instead, they stick to their long-term strategy. They're guided by financial principles, not market sentiment. They know that wealth is built over decades, not weeks. This disciplined approach is what keeps them on track during turbulent times. Let's take Liam, a tech entrepreneur. During the most recent market dip, many of his peers in the tech industry panicked and sold off their stock. Liam, however, stayed the course. By focusing on the long-term growth of his business and investments, he came out ahead when the market rebounded. 6. Professional advice and wealth management. Finally, the wealthy have access to financial advisors, wealth managers, and estate planners who provide expert guidance during times of crisis. These professionals help them navigate complex financial situations and identify opportunities in the chaos. You may not have a full team of experts, but you can still seek out financial advisors who are certified professionals, like a certified financial planner, CFP, or chartered financial analyst, CFA, to help you make informed decisions. This is exactly why it's crucial to have a plan in place. Instead of panicking when markets drop, you need to have a strategy that's built for volatility. How you can apply these strategies to your finances. Diversify. Make sure your investments are spread across different asset classes, such as stocks, bonds, and real estate. Build cash reserves. Having liquid cash on hand allows you to buy opportunities when the market dips. Focus on income-generating investments. Look for assets that provide cash flow, like dividend-paying stocks or rental properties. Leverage tax strategies. Invest in tax-deferred accounts and consult with a tax professional to optimize your tax situation. Stay the course. Don't get caught up in short-term market noise. Keep your eyes on the long-term goal. Get professional advice. It's worth investing in a good financial advisor who can guide you through rough patches. Remember, the wealthy don't just weather market crashes, they take advantage of them. And you can too, by adopting the same strategies. This content is for educational purposes only. Always consult a certified financial professional for personalized guidance. Which of these strategies will you start using today? Drop a comment below. I'd love to hear your thoughts. And if you're ready to take your financial knowledge to the next level, be sure to hit that like button and subscribe. If you found this helpful, you'll love the next video we've got coming. Click the one on screen now to keep building your financial future.